Today, we're diving into how a recent 50 basis point rate cut by the US Federal Reserve impacts various sectors of the economy. Now, you might be thinking, why should I care about a rate cut? Well, my friend, it impacts your money way more than you think. From the interest rates on your loans to the price of that new phone you've been eyeing, this seemingly small change by the Fed can have a ripple effect across the entire economy. So, whether you're a seasoned investor or just starting out, understanding the ins and outs of monetary policy is crucial for making smart financial decisions. Let's break it all down. First things first, a rate cut essentially means the cost of borrowing money just went down. Imagine this. You're looking to buy a house, and boom, interest rates drop. Suddenly, that monthly mortgage payment becomes a whole lot more manageable. The same goes for businesses. They can now borrow money at lower rates to expand their operations, invest in new equipment, or hire more employees. This drop in borrowing costs can be a huge boost to economic activity. Think about it. When it's cheaper to borrow, people are more likely to take out loans for big-ticket items like cars or homes. Businesses are more likely to invest and expand, which can lead to job creation and economic growth. It's like a domino effect, all triggered by a single rate cut. Now, let's talk about how this rate cut affects you directly. With lower interest rates, you might notice your credit card payments getting a bit smaller. Or maybe that car loan you've been eyeing now has a more attractive APR. This means you have more disposable income, which usually translates to, you guessed it, more spending. When consumers spend more, businesses see increased demand for their products and services. This can lead to higher profits, which can then fuel further investment and economic expansion. It's a virtuous cycle, and it all starts with a little nudge from the Fed. Ever noticed how the stock market seems to react to every little announcement from the Fed? Well, there's a reason for that. When interest rates go down, returns on traditional savings accounts and bonds become less appealing. Investors are constantly searching for the best returns, so they start shifting their money into riskier assets like stocks in search of higher yields. This influx of cash into the stock market can push stock prices higher. Of course, the stock market is notoriously unpredictable, and a rate cut doesn't guarantee a bull market. But historically, lower interest rates have often coincided with periods of strong stock market performance. Here's where things get a little bit tricky. When the Fed cuts interest rates, it can make the US dollar weaker compared to other currencies. This is because investors are attracted to countries with higher interest rates. A weaker dollar sounds bad, but it can actually be a boon for some sectors of the economy. For American companies that export goods, a weaker dollar means their products become cheaper for buyers in other countries. This can boost demand for American exports. On the flip side, a weaker dollar makes imported goods more expensive for US consumers, which could potentially lead to inflation. Remember how we said a rate cut can lead to increased spending? Well, when everyone's out there buying things, it can create what's called demand pull inflation. Think about it. If there's more demand for goods and services, but the supply remains the same, prices tend to go up. The Fed walks a tightrope when it comes to inflation. They want to keep the economy humming along, but they also don't want to see prices spiraling out of control. A little bit of inflation is normal and even healthy for a growing economy, but too much can be a problem. One sector that's particularly sensitive to interest rate changes is the housing market. When the Fed cuts rates, mortgage rates usually follow suit. And when mortgage rates go down, it becomes cheaper to finance a home purchase. This can lead to a surge in demand for homes, especially if inventory is limited. Lower mortgage rates can make homeownership more accessible to first-time buyers, which can further stimulate the housing market. However, a rapid increase in demand can also drive up home prices. making affordability a challenge for some. While a rate cut can be good news for borrowers, it can be a bit of a bummer for savers. When interest rates are low, the returns on traditional savings accounts and certificates of deposit, or CDs, tend to shrink. This can make it harder for savers to reach their financial goals, especially those living off fixed incomes. Retirees who rely on interest income from their savings might feel the pinch of lower rates. It's essential for savers to explore different investment options and adjust their strategies during periods of low interest rates to ensure their money continues to grow. Remember how we talked about investors chasing higher returns when interest rates are low? Well, this can sometimes lead to a phenomenon known as reach for yield. Essentially, investors might be tempted to put their money into riskier investments that offer the promise of higher returns. While there's nothing inherently wrong with seeking higher returns, it's important to remember that higher returns usually come with higher risks. It's crucial to carefully assess your risk tolerance and investment goals before diving headfirst into any investment, especially during times of low interest rates. Lower interest rates aren't just good news for individuals. They can also be a boon for businesses. When borrowing costs are lower, businesses can access capital more easily and at a lower cost. This can free up cash flow to invest in growth opportunities, expand operations, or hire more employees. Additionally, lower interest expenses can directly translate into higher profits for businesses, which can be good news for investors. Companies might use these extra profits to pay down debt, increase dividends, or buy back stock, all of which can boost shareholder value. One of the main goals of the Federal Reserve is to promote maximum employment. When the economy is strong, businesses are more likely to hire, which can lead to lower unemployment rates. Rate cuts can play a role in stimulating economic growth, which can create a more favorable environment for job creation. When businesses have access to cheaper credit, they're more likely to invest and expand, which often translates to more jobs. A strong labor market is good news for everyone, as it can lead to higher wages, increased consumer spending, and overall economic prosperity. While rate cuts can be a valuable tool for stimulating the economy, it's important to remember that they're not without risks. One concern is that lower interest rates can lead to excessive risk-taking by investors, potentially inflating asset bubbles in the stock market or real estate. Another risk is that rate cuts can lead to higher inflation if they're not carefully managed. Additionally, if rates are kept low for too long, it can limit the Fed's ability to respond effectively to future economic downturns. And that's a wrap on how a Fed rate cut impacts the economy. From borrowing costs and consumer spending to stock market movements and inflation, these seemingly small adjustments to interest rates can have a ripple effect across all corners of the financial world. Remember, knowledge is power, especially when it comes to your finances. By understanding how economic forces like interest rate changes can impact your money, you'll be better equipped to make informed decisions about your investments, spending, and overall financial well-being. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more insights. See you in the next video. Stay informed, stay ahead.